Okay, let's talk about the US housing market. Because if you've been even slightly paying attention, you've probably noticed something weird. Home sales are dropping, prices are still skyrocketing, and everyone's acting like this is the new normal. But wait, if fewer people are buying houses, why are prices not falling? That's the paradox we are diving into today. And honestly, the answer reveals way more about our economy than just real estate trends. Let's unpack this. So, the headline says existing home sales fell 1.7% in July. Not a huge drop, but it's part of a pattern that's been building for years. The median price? A record $434,100. That's up 2% from last year. Meanwhile, mortgage rates just hit 6.69%, the highest in over a year. If you're a first-time buyer, this probably feels like trying to catch a train that's already left the station. And here's the kicker. Economists predicted slightly worse numbers, but the market still didn't react how we thought it would. Why? Let's break it down. First, the inventory crisis. There are barely enough homes on the market to last 4.6 months at the current sales pace. Historically, you need 5 to 6 months of inventory for a balanced market. So we are not just low on houses, we are in a full-blown shortage. And this is where my brain starts spiraling. If we built more homes, wouldn't that cool prices? But we are not. Why? Because construction costs are through the roof, land is expensive, and NIMBism is still running wild. This isn't just a housing problem. It's a supply chain, policy, and cultural issue all tangled together. Now, the mortgage rate spike. Rates have gone up because of inflation fears tied to oil prices and geopolitical tension, like the US-Iran conflict pushing bond yields higher. But here's what fascinates me. Even with these rates, sales aren't collapsing. They're slumping, sure, but not crashing. That tells me demand is still there. It's just being choked by affordability. And this is where the generational divide gets ugly. First-time buyers made up only 29% of sales. Historically, that's around 40%. So who's buying? Investors? Cash-rich millennials? People taking out jumbo loans they can barely afford? The data doesn't say, but it smells like a market that's becoming a closed club. Let's zoom out. The National Association of Realtors keeps saying, sales are stable. But stable compared to what? The last 3 years have been a 4 million unit treadmill, way below the 5.2 million average we saw pre-2020. This isn't stability, it's stagnation masked as equilibrium. And the Northeast's 5.2% price jump? That's not just a regional quirk. It's a warning sign. Places with older, fixed housing stock can't scale supply, so prices become a pressure cooker. Imagine this dynamic spreading nationwide. Scary, right? Here's my biggest takeaway. This market isn't just about homes. It's a symptom of an economy stuck in limbo. Too much demand, too little supply, and rates that punish risk takers. And if mortgage rates stay above 6%, we are looking at a decade where home ownership becomes a luxury asset class. Not a stepping stone. Not a right. A luxury. What does that mean for wealth gaps? For mobility? For the next generation? I don't have answers, but I'd love to hear your thoughts. Drop a comment. Do you think the housing market slump is hiding something more dangerous?